Good evening, all. Ira Epstein with your metal market wrap-up, and this wrap-up is for Thursday, the 16th of February, 2023, and right now at 6:15 p.m. Central Time. You know, I've been waiting to see the one time recently that we get a market that gets, again, very, very bullish inflation news, breaks early in stock indices, holds down, and then late in the day just rallies back up like nothing occurred. Well, today was the opposite. Today was the day you broke, you came back, and then late in the day, you reversed down. Right or wrong, I told my clients to jump on the shorts at the end of the day. We'll find out. It's going to put pressure, if I'm right, on the metals too, because what is taking place is the market's got to come to terms that every report coming out just shows inflation is much stronger and stickier than the marketplace thought. The market, has been talking, we'll get into February, you'll do a rate hike, and then the battle will begin. You'll never get another one done. Nah. You'll get one in March, and then when the May report runs around, the Fed won't have to do anything. Well, if you take a look at the CME FedWatch page, you started off, a month ago at a 5% or so chance that you could get another 50 basis points into this. Well, now all of a sudden, the market at anywhere between 5 to 5.5%, up to 18%. Obviously, the market is still saying that most of the bets there are that we'll get a quarter point hike come February, but that doesn't mean it's not sticky. And there lies the dilemma. So does the dollar go up on that news or down? Well, in the early evening trade, most of the currencies are lower, so that tells me the dollar's going to gain. If the dollar's going to gain, there should be some pressure coming into some of the metals. I think we're getting that. The copper's making a statement, in my opinion, that the $4 level is still a bit too cheap. If we take a look at the energy markets, be it gasoline, any of the crude, they're down, pressure coming in there, and bonds and notes are adding yield. Every time they're lower, you're getting more yield. So as I view it from my perspective, I've been waiting for when the market would come down on the stock indices, and to me, that would be the signal that maybe, just maybe, the market's getting a shift where things that are bad are actually bad. Could be. Here's the gold chart, but before I get there, I want to make a statement to you all because I know I've got your attention. It's President's Day. Any of my research, this is not my charting course, it's my research. I don't care if you go for research for 1 year. I don't care if you go for the research for 1 month. 50 off for new and returning members. Existing clients know you don't get 50 off your existing part. You know I keep offering you specials. I just did it today, in fact, in a mail to them for my courses. So I'm very good. I'm loyal to the people we've got. But we need to add more people. We always do that. That's what the machine's all about, right? So I don't care if it's my Spider ETF, my package that's the combo of both futures and that, 1 year packages of both, whatever way you want to go, it's there, 50 off, you can cancel whenever you want. Take a month, you can cancel. Take a year, well, it's for a year. Please consider it. This will run through President's Day and it's over at that point. So you got a few days to do it. If it were me, I'd take advantage of it. I don't offer these that often. You don't get holidays like this that often. So let's go back to the chart action. So as I was saying, if you look at gold on the weekly close, the market's still falling. You're down on the week 1%. But I'm still thinking this market acts like a market that it's like a magnet, wants to come back down and challenge that 18-week moving average of closes. As we take a look at the bar chart, you keep leaking down. When we take a look at the swing lines, they're bearish, lower highs, lower lows. Where could we go? If you'll recall, it started at 1812. Now it's 1810.20. So the averages will change a little to 1804.90. Those are the two main moving averages. And then the Bollinger Band comes right in with it now at 1819.40. That's the zone. You're getting pulled into that area. Does it have to go there? No. Why? Well, it doesn't have to if it loses the embedded reading. But if this reading stays as it is, why not? This says that on each and every rally, the pros are waiting to sell the market short. If you've taken my enhanced Bollinger Band course, there's a way they do it, and they'll hit the market until the market gets down to one of these main numbers. Does it have to do it? Nothing has to do it. But what's going to hold up gold? I look at it this way. If interest rates are going higher, you know where the Fed goes. It's not going to the back end. It's going to the front end. We're getting over 5% in 2-year notes. We're getting up there in even 6-month paper. You're talking 5.5%, maybe 6% if this thing stays sticky. I don't want to own gold in that. I want to own 6% of my money. I think that's better than the inflation rate. I'm a net, at worst, flat. That's a pretty good place to be. This doesn't pay me any interest. So those are the thoughts. Now, there could be a flood into interest rates if people believe that, because this stock market has been bucking, and I think you know that. Every piece of news. Since last June, the traders have been saying the Fed will never hold the rate. Well, now you got a little something to think about. I think they were right to the point where we're getting sticky. The first 3% of inflation that came off, a lot of that had to do with supply chain, the COVID issues, and so on. We in the West now live a much more normal life, and inflation is strong. Labor is strong. What does the Fed have? One tool. What is that tool? Interest. And their job is going to be to take it to the level where there's enough pain to flush out that excess in the market. I read tonight that the consumer is up to $1 trillion in credit debt. So they keep buying. You see that in retail sales, PPI, CPI. Okay, that party ends too. I've been around this. I've been in this cycle before. Fair warning. When you look at the gold, silver, continuing to move one way to the upside, silver continues to lose to the gold market. You see that on this chart. Now we are down to an area where maybe you're going to get to the 21, 22 level. Again, embedded, bearish. No sign yet that this market is through to the downside. Copper did have an oversold condition. It never embedded. It's working that off. And you tell me the number that it's running with problems at, the 18-day average of closes. Markets often, when they get a big move up, they'll pull back, and that 18-day average becomes a zone they'll fight at. When you're down a lot and you come up, that becomes it. But it keeps the bias down or the bias up until the market stays under that number. Right now, the bias is down. Keep reading about how China's going to turn inward and what they're going to do with copper and so on. I'm even reading reports that China, end of COVID, doesn't have to be as inflationary as everybody's been led to believe. Okay. I don't buy it, but okay. In the platinum market, coming down, embedded. All these embedded readings, understand them. Embedded is when the two numbers that make up the slow stochastic, they're red and blue, but they're called the K and the D line. And when they lock in under 20 or lock above 30, they're either super bullish, super bearish until they're lost. And what happens is the people that don't get it, they'll go, this market can't keep going down. I, for certain, was one of those guys 20 years ago in my career, maybe 25. And I've been doing this since 69. It took me a long time to learn about that. And once I learned it and I perfected it to the way that I want, it changed everything about how I approach markets. And you keep that discipline and you work with it, and I enhance it with teaching you about it each morning in my morning subscriber videos. But you're there on rallies. I think this market still gets sold until these readings are lost. You don't have that reading in palladium. So copper and palladium are the two exceptions in the metal that don't want to embed. The others are staying embedded, and the U.S. dollar developing its embedded reading. Both numbers over 80, as you can see. Let's see if I can get that. It's not going to let me do it on the top. I'll fix that for my next video. But we're at that point. So until the red line closes back under 79, it's the flip-flop. Well, I don't think it's going to easily stay over the Bollinger Band, so any breaks in the market, I think, get well bought. And that's a flip in the market, because before we were talking bearish the dollar, but I think the world's got to understand the Fed's going to get much more. I want to use that word very carefully. Much more aggressive. They're going to stay much longer than the people that don't believe that. And yes, Unemployment will have to go up to about 4.5%, and interest rates can go 5.5%, 6% until they're done. If the game changes and the CPI and the labor and the retail sales and the PPI all come in lower, fine. But everything we're showing says no. You had the unemployment claims today. They fell 1,000. They didn't go up. That's 5 weeks in a row under 200,000. People are still getting employed. They're getting better jobs if they're laid off. There's a rotation here, probably higher paying. There's something big going on. Take advantage of what I'm talking about. Learn from me. Join me in the morning. See how the chart formations come together for buy-sell ideas. 50 off? Come on, give it a try. So if you took it for a month, what are you going to spend on this for your first time? $4? I think you can afford that. The better players take it for a year because you're not going to want to pay 50% more, but you will once you see what I do. I'm Ira Epstein. You have a great day. I will catch you all tomorrow.